choice made in the boardrooms of power that set in motion a chain of events leading to the largest bankruptcy in US history and triggering the 2008 global financial crisis. This isn't just a story about numbers on a balance sheet. It's a cautionary tale about hubris, a story of how one decision, one moment of collective denial, can bring a giant to its knees. Welcome to the One Decision, where we explore how famous companies collapse because of a single critical choice. One meeting, one decision, total collapse. They found a way to take these risky mortgages, bundle thousands of them together into complex financial products called collateralized debt obligations, or CDOs, and sell them to investors all over the world. The thinking was, even if a few homeowners defaulted, the vast majority would keep paying. The risk was spread out, so it seemed manageable. For a while, it worked brilliantly. The profits were astronomical. Lehman Brothers, under the leadership of CEO Dick Fuld, nicknamed the Gorilla for his aggressive style, became one of the biggest players in this market. They weren't just selling these mortgage-backed securities. They were buying them up for their own portfolio, convinced they had cracked the code to infinite profits. While some in the market were starting to get nervous, seeing cracks appear in the housing foundation, Lehman did the opposite. They decided to dramatically increase their leverage. Now, leverage in finance is basically using borrowed money to amplify your potential returns. If you have $1 and borrow 9, you now have $10 to invest. If your investment goes up by 10%, you've doubled your original dollar. Amazing, right? But if it goes down by 10%, your original dollar is completely wiped out. It's a double-edged sword. Lehman's leadership made the decision to push this leverage to the absolute limit, and then some. They went all in on the real estate market, particularly commercial real estate, and those risky mortgage-backed securities. Their leverage ratio soared to over 30-1. That means for every $1 of their own capital, they were playing with over $30 of borrowed money. They had built a skyscraper of debt on a foundation of sand. This was the one decision. The moment they chose to ignore the warning signs and press the accelerator instead of the brake.